But not out, down about 60 odd points, but let's see how it goes. The Sensex is down over 200 points. So yes, we've opened on the back foot courtesy B Global Qs. The mid-cap index is down about 100 odd points. Bank Nifty as well, down 200 odd points. So the start is a tad bit in the red, down 0.3% for the index. What's dragging this morning is banks. Axis Bank, SBI, SBI Life as well is down under a bit of pressure. And then you have IT stocks, Tech Mahindra, Infosys, Wipro, TCS, HCL Tech are all under pressure, down about 0.7%. Reliance is also dragging its feet a tad bit, so keep an eye out on that. But the losses are not getting worse, so it's still just stuck with about a 60-point loss. What's batting for the bulls this morning is HUL, Asian Paints, some of the FMCG names. Tata Steel, of course, post their numbers. Dr. Reddy's, UltraTech Cement, BPCL is up about 1%. Crude has fallen, so BPCL is up and about. Apollo Hospitals is up about 0.6%. Cipla, HUL are also in the green at the moment. So you'd have to say it is a start that is going by what the SGX was suggesting, a start in the red, down about 60 odd points, but it's not getting worse as we speak. The Bank Nifty is the one that's dragging right now. Axis Bank is down about 1%, ICICI Bank is down about 0.5%. But otherwise, the market breadth is split down the middle. So let's see how the rest of the day goes. The start is a tad bit in the red.
Well, all right, Sonia, keep an eye on a few stocks. Go Air, they have filed for bankruptcy, and there is exposure to Central Bank as well as Bank of Baroda. So both those two stocks actually have opened up in the red. Keep an eye on that one. Sanghi Industries, the street is speculating whether or not that could be a deal that could come about, because the promoter entity clearly is struggling to run the asset. Valuations, though, that are reported are very elevated. We'll have to see whether or not it happens. But Sanghi Industries has opened up with a gain of another 3.5% or thereabouts. You have Bansali Engineering. I don't know what's going on there. They just announced that they're going to be declaring their results on 14th of May. But Bansali Engineering, in the pre-open itself, it was up close to around 10%. I don't know whether or not that's stabilized. So let's pull up Bansali Engineering, up close to around 10%. But on the exchanges, I don't see any new update that's come in there. Spandana Spurti, well, that's up and about. The AUM growth in the last year was very, very good. And the street appears, they're quite optimistic out there. The management has guided for the ROA as at around 4.5% as well. So that's another one of those stocks that have opened up well in the green. Let's pull up a couple of other names. Ambuja Cements, let's see how that one's doing today. That stock, the operational performance actually was much better than what the sheet was working with. But as flat as can be, maybe some pre-positioning out there as well. And Coforge, a day after the promoter entity lightened positions yet again. You'll had Motilal Oswal, multi-cap 35 fund that bought close to around 0.8% in that trade. It's opened up with a cut of around 0.5% or thereabouts. So it's a start in the red, and as we speak, we're at the low point of the day, just a few minutes into the trading session, though, Prashant.
Nigel, so 80 points lower on the Nifty at 18,070 around, not dramatically different from the opening levels, maybe a little lower than that. Let's just have the Nifty Bank quickly take a look at that. The mid and the small cap indices to just establish how the open has been, and that gives us a reference point. The Nifty Bank is down 0.5. The mid cap index is doing a little better. It's not as much as the Nifty, not down as much as the Nifty or the mid bank index, and the small cap index also, I think, is doing a little better. Those indices, by the way, yesterday were up around 1%, even as the Nifty did pull back into close. Okay, a few other names. RVNL, right? So we've been talking about this absolutely crazy rally we've been seeing in RVNL, and the move continues on RVNL. From the end of March, the stock has basically doubled RVNL. So this is quite incredible what we've seen in RVNL over April and this month so far. Indigo we mentioned, but look at IRFC again. Just complete momentum names here now. 1.6, 1.7% higher. I'm seeing RailTel, which is up about 2.5%. So this entire railway infrastructure pack is, coming up with very strong volumes once again. Varun Beverages is up about 2.25%. Stocks at about 1446 now. BPCL is up 1.6%. Spandana we mentioned. Aavas Financiers is another one, which is up about 3.25%. That is Aavas at 1445, 1446. So refineries are doing well. So there is BPCL, HPCL is up about 3% as well. Chennai Petro is up about 1.5%. This is, of course, the fall in oil that we've seen. MRPL is up about 3% as well. So that is a very distinct bunch of names which is moving up. CET had a very sharp move last Friday. Stock ended about 9% higher, then pulled back over the last 2 days. But stock's up about 2% or so at this point in time. And on the way down, I think apart from what we've already mentioned, there's not very much. Maybe PSU banks is something to focus on. Bank of Baroda is down. There is Central Bank of India, Central Bank is down a full 5%. UCO is down 3%. Union is down about 2%, and so on and so forth. So that's broadly the picture. Market breadth is almost 1:1. Little tilted in favor of advances.
Just one point, Prashant, we were highlighting Bansali Engineering. In the release, they've also mentioned they'll consider a bonus issue besides the results. So that's the reason why, in fact, the stock is up close to 9%. And JSW Steel, well, this release has just come in there. Small investment they're making, $145 million into their US business out there to upgrade the manufacturing operations. So we'll wait by for the numbers and find out what more they want to do. But Sonia.
Okay, yes. I just want to mention Indigo is now up 6.5%. Yes. There is this whole talk about how now the aviation sector could head into a duopolistic structure. Now there are just two big players. There's Interglobe Aviation and there's Air India. And they both have niches of their own. Interglobe is largely into the LCC space. Air India is a full service provider. So, they both will, in a duopolistic structure, there is a lot that the two players have to benefit from. And gaining market share from Go First is, of course, getting priced in. But this is a larger story, I think a structural story for Interglobe that a lot of people are looking at. So perhaps.
Interglobe and Tata's on the other side, right? With all their airlines probably into one fold at some point in time, as we've been kind of discussing. Well, 83 points lower on the Nifty is what we have. Ajay Srivastava is with us, Chief Executive Officer at Dimensions Corporate Finance Services. Ajay, good to have you with us here. Thank you very much for your time. We'll ask you about the airline business, and I think I have an inkling of your views on that. But your views on the market, have you been surprised with this move higher that we've had? Almost 4 or 5 weeks now, running into some resistance now. Your thoughts, Ajay?
No, I think first of all, I'm glad now that you can start predicting me. I think you are the best AI chat box out there, which is going to start predicting people. So great stuff, man. You don't need people anymore. You're going to compete on the other side. No, I think, market, as we always said, that Indian market is less driven by fundamentals, more driven by flows. And we have seen the same thing happening. Once the selling of FI stopped, it was a natural course of the market to start edging up, and FIs have bought some stock in that. And therefore, the market has taken up a little bit of wings, so to say, to come back to where it was. But for investors, I think the dilemma again becomes same, that do you invest now or do you get out? And I think that's where the problem starts, that if you start investing again at 18,200 levels, what kind of returns you get? So more than the celebration of 18,200 for an average investor I'm meeting on the streets and the planes is more concentration. What do I do with it? When the market is down, they know what to do. But now they don't know what to do. So I guess, we're never happy.
Yeah, that's true. Since it's the big talking point, I'm going to ask you about it. The entire aviation space is booming, right? I mean, tickets are soaring, hotels are full, travel is back in a big way. And at such a time when Go First files for insolvency, Indigo has everything to gain. The stock is up 6.5% today, but for someone who's perhaps missed out on the rally, you think there's more to go?
Sonia, there's an old song called Fly, Robin, Fly. And this song so applies to industry. There is up to the sky. There is nothing else. And for Indigo, I own the shares for disclosure, so please don't take it as that. I still believe that if there is a competitor you want in the market, you want Tata's to be on the other side. That's the best competitor you want. You don't want Reliance on the other side. You want Tata's on the other side. So for Indigo, it is God's an opportunity, and not that Tata's not going to make money. I spent some crazy amount of money on the flights, which is unbelievable last week. So I think sector has you rightly said, a duopoly is now in the making. Not making, is already made. There's nothing much the government can do except put a lid on the prices, which I think is going to come very soon, in my view. So therefore, one would be wary of adding up more at this point of time and wait and see how the government reacts to what's happened on the pricing front. And, the pricing has gone crazy, absolutely bonkers. So while longer term, there is a clear story for both the players. One is listed, one is not listed, so you can't really participate in the other one. So therefore, as a sector, you can't get better than this because this is a clear monopoly. And as I said, you want Tata's to be a competitor. It's God sent for somebody like that. But it's unbelievable how Indigo has created this and what a niche they're in now. Unbelievable story. Story is still to happen. It's still just the beginning. I think the real one is going to happen in the next 2-3 years. As we saw what happened to the hotels, same is going to happen here.
Hi, Jay. Good morning.
Good morning.
Put some cap on prices would be good, right? For us, not too good, I think, for the companies. But as you said, prices have gone through the roof. But Ajay, the consensus buy this year has been banks. But I think in the past you have mentioned as well that you wouldn't be in that camp. You think there are better opportunities rather than banking names. What's your view on the banking stocks, the financial names from here on?
Still the same, Nigel. I still believe that as you're seeing unfolding, the luxury consumer discretion story has done a lot better. The metal story, banks, are an over-owned asset by the entire investor class. That's a problem with it. Stocks rise over time because they are under-owned and therefore new investors want to jump in. Everybody owns the bank. When the SIP goes in, they all buy the bank. And so the point remains that what's the trigger for the banking to give you superior than market return? That's what you're aiming for, right? You're not aiming for a banking sector to give you less than market or market. And that's where the trigger is not there because you don't have a monopoly kind of situation. You have a grandfather called RBI who ensures you get profits. And the fact remains that every time banks make money, it's at the cost of the rest of the economy because who's paid the interest? Is a common person has paid the interest, the corporates have paid the interest. So whenever banks do well, you will find that next 2 years, the economy lags. And when the economy lags, it's a cycle, the banks will not start to have the problem, the loan. You already seen the first ECLS default has already happened. Go first, the first ECLS default. Many will follow in the path. The whole trajectory is personal finance. The whole trajectory of banking industry is personal finance. In an economy which is slowing down, unemployment is pretty well high at this point of time. Personal loans are perhaps the most riskiest loans. RBI has sounded a warning, but I'm not sure people are hearing it. But the fact is, the whole banking industry is today sitting on just the edifice of personal loan, unsecured loans. It can go on for some time. How long it can go on? So the composition of earning worries you about the bank's growth path. It's not the banks per se, but the composition of earning. And therefore, I still believe the Indian industrial economy, the high-end consumer spending sectors, some of the metal sectors will give you superior returns than the bank. You already own it in various forms and shapes. You can't not own it, but to over-own it perhaps is the problem.
By the way, just have the NSE advance decline up. That's the advances have run away suddenly, and you'll be able to see it, I think. The gap is widened. It was almost 1:1, and now you've got almost 1,200 stocks higher and about just under 800 stocks which are lower. There you go. That's what I'm talking about. So the broader market is starting to run up once again, like what we've had over the last many sessions. Ajay, so actually two questions, but both are follow-ups. So what is your view? I mean, the first answer on markets, you said, well, people are not happy when the markets were down and they don't know what to do now. But what is your view? What to do now? And second, I think you threw in that line that maybe FA caps are coming. You said you own Indigo. If that were to happen, I mean, you sell and run, or what do you do?
No, I think you just wait it out because you've seen, different sectors, what government did. If you look at the steel, go back to look at the steel sector. That had a steep correction, it came back. So if you're a longer term, you will add on corrections. So if you see what happened to the sugar sector, after the price control and look just now the export ban, you've seen what's happened to the sugar stocks. So you've seen what happened to the oil stocks at this point in time. So government interventions obviously have a negative connotation to the stock, but that perhaps may be the time to get an opportunity to get into the stocks. And runaway situation like this, if you start to buy and make money, very difficult. Wait it out. Government action will come. It's election year. They cannot afford economy fares at 20,000 rupees and people, the social media is a gosh, if you're all a part of it, I'm sure, is what's happening on the airfare. So I think it's coming. It will come, whether it comes today, next week, what they do, I do not know, but I think it will come. That should be a right way to get into the market. Number two is, you said about the market. I still believe this is a good time to put some cash on in the books. Book your profit. If your chemical stocks have now recovered, I would say book your profit. If retail stocks have recovered, book your profit. If fashion apparel has recovered, book your profit. These sectors are going nowhere in this year. I can promise you this much. The market indications are that April has been very, very bad for the retail sector at this point of time. May is not looking, just started, so we don't know. But April has been pretty bad. So if you have got exposure to these sectors, this market gives you the best opportunity to sell. You love to sell when the market is green because you can sell at a good price. You don't want to go to the market when it's 10% down. So I would say lots of sectors now have recovered, still overvalued. You may want to get out, book your profits if you have, and get out and put some cash. You will get chances to buy again. A lot of sectors are not going to perform in this year. Economies are 5 to 7% at best, as RBI 6.5%. You'll get chances to buy. So don't worry about it. I would say book your profits in sectors which are weak, and certainly 5 or 6 sectors we can see are going to be very, very weak this year.
Okay, so you're saying that you're not buying anything now. You're still negative on equities. Since we last spoke, of course, you were talking about other asset classes as well. So this is not the time to be buying. This is still the time to be booking profits, right?
You can shoot me in the head to buy at 18,200 and make a return out of it. So just shoot me in the head, might as well do that. Because, you know, as I keep saying, that buying in euphoria gives you high.
I choose non-violence. This is for the benefit of our viewers.
Okay, you can substitute my chat box.
No, I'm asking because, you know, I mean, a lot of the headwinds, so-called headwinds for this market are now, you know, sort of easing, right? I mean, we were speaking to a global expert earlier who said now we're going to head into a cycle where there could be a rate cutting cycle from the US Fed. What happens then at the start of the new year?
See, you know, rate cutting cycle is a precursor to the fact that the economy has to slow down for the rate cutting cycle to happen, which means the demand of goods and services have to drop, Sonia. That's the bottom line for a rate cutting cycle, which means that your demand for exports, demand of products has to go down in the market for the, you know, for it to come into effect. And that also means in the first stage that your ability to sell products and the growth of the companies will stall. You know, last year we had a good optical growth thanks to the high inflation. Now with inflation hopefully coming down, the optical element of growth will also start to disappear. And you've seen that already, that what's happening to the sales growth lines, what's happening to the net profit line, etc. So while interest cost will not go down eventually, the high interest costs are here to stay. But the demand of the product has to go down first before the interest rate cycle comes down. And when demand goes down, company performances should lag. And we're already seeing in the market that the portion of the money going to the bank extra EMIs is going away from some place. That's one. Number two is globally and in India, Sonia, most importantly, people are trading experiences for goods and services, not services, goods particularly. So you rather take an expensive holiday or expensive hotel, then go buy a new phone or buy a new watch or buy clothes. So, you know, so we also as investors need to change our mindset to say, when people are demanding experiences versus goods, it's best to be invested in companies giving experiences and not goods. So yes, interest rate cycle should come down eventually and everything goes up, goes down. But the fact remains that the world economy is not going to grow into 4 or 5%. India is not going to grow at 10%. When India grows at 6%, there is only so much companies can grow. And that's a perspective you got to keep, to claim and use the market highs to your advantage.
All right. Thanks a lot, Ajay, for joining in.
Thank you very much.
I'd love to chat some more, but we'll take this forward at another time. Thanks for being with us on CNBC-TV18. Let's do one thing. Let's just get back to the markets now. It's not bad. Actually, the mid-cap end of trade has moved into the green. So, you know, there is some buying on dips that we're seeing in the broader markets. The headline index, though, has seen some incremental pressure. So it's kind of a mixed bag that we're seeing in the market today. The headline index is falling some more, while the mid-caps are trading in the green. Let's give it some time to adjust, and then in the meantime, we'll focus on some more numbers that came through. Star Health Insurance is what we're looking at. The company reported a stable performance in Q4. Net earned premium as well as gross written premium saw good double-digit growth. The company is guided for improved combined ratios in FY24 and higher than industry premium growth. Anand Roy, who's the managing director at Star Health and Allied Insurance, joins us now to talk about that. Anand, thanks a lot for joining in. If we can just start, it was a stable performance this time around, but I'm trying to look ahead. What kind of premium growth are you looking at for FY24? And are you expecting the growth to come in from value or from volume?
Morning, Sonia, and thanks for having me. Always a pleasure to be on your show. Yes, so we have had a satisfying performance in the last financial year. We were able to meet the guidance that we had given to the markets as far as our growth is concerned. In terms of our retail performance, we grew at 18%, which is almost 20% faster than the industry's growth. We were also able to deliver our lifetime highest net profits. We were able to deliver a profit of about 620 crores for the financial year. And of course, the guidance that we gave on our overall operating cost of 95%, we were able to meet that. So overall, it was a satisfying year. As far as this year is concerned, we have very aggressive plans to grow faster. As I told you, our growth was a little muted in the last year because of a group policy strategy that we had, and that has played out. So this year, we expect that, we should be growing at 20% plus for the year, which will be faster than the industry's growth.
20% premium growth, Anand, in FY24?
That's correct. That's correct, Prashant.
Okay. And you're saying that the reliance on group policy continues to come off faster?
Yes, so that has happened over the last 12 months. This year, the strategy is to focus on the small and medium enterprises groups, which will contribute around 10% of our overall GWP. But it will be the selected segments that we want to participate in.
Okay, all right. Hi, Anand. Good morning. Anand, what kind of a price hike are you baking in for this year, if you could tell us that? And also run us through your loss ratio. I think the claim ratio, I think you were guiding that it'll move around from here. What is the number we should work with for FY24?
So, Nigel, the loss ratios will hover around 63 to 65%. We have taken a price hike in one of our leading products, as we discussed in the last meeting. That's our family health Optima. We have taken a 25% price hike, and that will play out over the next 12 to 15 months when the renewals come up for the customers. So we expect that the loss ratio should hover between 63 to 65%. But probably because of the price hikes and other underwriting strategies that we have, at the lower end of the band of 63 to 65%. That's what I would expect it to.
Okay. And I also want to understand, what is the retail market share that you're targeting for the end of FY24? I think you're sitting at somewhere around 33, 34% currently. What would the strategy be to grow your retail market share, and what's the guidance?
Yes, Sonia, for the last 2 years, if you look at the numbers, we have grown from 31% market share to 34% market share. And that's something that we really are focusing on to keep on increasing our retail market share. So we expect that these market share will grow by 100 or 200 basis points every year as we keep growing faster than the industry. I think that will be the focus area.
All right. So you'll end this year with closer to around 35% odd, right? From 34, you're at least 35% is what you're looking at.
Yes, that's right.
Okay. All right. Also tell us a little bit more about your mix. You wanted to increase, I think, your share of specialized products. And I think it was at around the mid-teens. Where do you see that number headed?
So, Nigel, the specialized products are products which are basically trying to cover individuals who otherwise could not get a health insurance normally. Probably the senior citizens, people who are living with pre-existing ailments, and so on and so forth. That's definitely our focus area. We are looking at creating new distribution channels for that specialized products. Probably we will be partnering with our hospital networks to find out how we can distribute these specialized products through those networks. We are talking to a lot of insurtech firms on distribution through online pharmacy chains and so on. So this will be our focus area. We have increased the contribution from 11% to 15-odd%. And we expect that, over the next few years, this will keep on increasing.
Another on expenses, I mean, these new regulations, expensive management, etc., is everything settled, and what should we expect? It's a question which we come back to, but if you can provide us with some sense for FY24.
So, Prashant, I think this is one of, the advanced thoughts that the regulator has in terms of, increasing the penetration of insurance in India. And the expense of management norms, which has now been articulated, is very, very beneficial for all the players and all the stakeholders. As far as Star Health is concerned, we probably are having a benefit in the sense that the allowable expense of management provides us headroom up to 35%. We have one of the most frugal operating expenses in the entire industry. We are operating at less than 30% right now. So we will take, strategic calls where to go more aggressive, since we do have a headroom for increasing, our, expenses on certain areas. But having said that, the company is more focused on increasing the retail market share, and that's where our focus would be.
So your group business, you said that you will grow it from currently, I think it's about 6% of your total business. You're looking to grow it to 10%. That's by FY24, correct? And then eventually, I mean, what is the long-term plan with the group business?
So the group strategy will remain to be around 10%. And there are two segments in the group business. One is which are the corporate groups, which is largely that is the area where we are more selective. And then we do have our groups coming from bank assurance partners. That will continue to grow fast, but the corporate groups will be very selective.
Okay, we will end the conversation on that note. Thank you for giving us all of those details. So expect their market share to go up. They're also looking at 20% premium growth in FY24. Their market share, in fact, has risen in the recent past from 31% to 34% in the retail space, and they're looking to raise it further. Let's slip into a quick break. Up next, Amit Agarwal of DCM Shriram will join in to discuss Q3 earnings. Later, we'll connect with Anil Gupta of KEI Industries to talk about their Q4 performance. Stay tuned.
Welcome back. Well, the markets are a little bit lower. They have come off the low point of the day as we speak. So that 18,060 odd mark has got defended. The heartening fact, though, yet again, is the mid-cap index. That's up close to around 50 points odd. It's recovered all of its losses and moved well into the green. And the number of stocks that are advancing are way more than the number of stocks that are declining. But a couple of stocks are reacting to numbers. And DCM Shriram, well, they posted a weakest set of numbers led by the chemicals in the vinyl segment. Their margins contracted as well. Debt as well has gone up a little bit, although their sugar business has seen a good improvement. But to understand what's the way ahead, we're joined by Mr. Amit Agarwal, the Executive Director as well as Chief Financial Officer at the company. Hi, Amit. Good morning. Thanks so much for joining in. Well, the street is reading these numbers as a little bit disappointing, particularly on the margin front. Could you tell us what is the guidance for FY24? Last year, you grew by close to around 20%. But on this sort of a base, what is the growth you're working with? And also on a blended basis, what is the margin band?
Yeah. See, for the full year, if we see FY23, our revenue has been a historic number of about 12,000 crores. And our EBITDA was over 1,700 crores and a PAT of over 900 crores. So I think it has been good numbers for the year as a whole. Now, going forward, I would say, the way we are looking at it, yes, there is a bit of a stress in our chemicals and vinyl business. But there are businesses like Farm Solutions, there are businesses like Finesta, which are doing well, which have become big. Sugar, we are seeing better margins going forward, given that our crush has been at a historic high, our recoveries have been better. On top of that, we are seeing a good inventory level in the country and internationally, which should support prices. Already the international prices are again at historic highs. So again, sugar should support. So for the year as a whole, going forward, like last year, we had our EBITDA margins of close to about 14%. They should remain range bound, maybe plus minus 1-2% going forward.
Amit, hi, morning. Sorry, so what would FY24 revenue growth look like? I mean, do you have a number in mind?
See, I wouldn't have a straight number in mind, but it should be a little better than this year, given that, we have invested about 530 crores in H2 of FY23 in sugar. So we have a full year impact on revenue. Secondly, our chemical projects, adding up to about 2,900 crores, they will get commissioned in Q2 of FY24. So they should also add to the revenue.
So revenue growth and margins in the mid-teens.
Margins, yes, as I mentioned, they will be in mid-teens.
And better than last year will be more than 20% growth, right? Given the kind of capex you put on stream. Better than last year?
The revenue, as I said, should be maybe around 10% higher, given that these projects, they take time to really ramp up. It's not that it will happen from day one. So, yeah.
Okay.
You said, sorry, just to pick on that one point on sugar, over the weekend, this is unrelated to the earnings that you've posted, but over the weekend, there were some reports in newspapers which suggested that the government may look at, a ban on export of sugar. I don't know if you picked up on that, or is there any discussion? I mean, if something like that were to come through, this is an important election year, etc. as well, leading up all the way into the general elections next year. How do the calculations work out on the sugar side for you?
See, this season, the domestic inventory should end at around 4.6 million tons, which is the lowest ever. Right? Last year also we had about 6 million tons of inventory. The export quota, which was announced in this season, has already been completed. So, the ban, I don't think, there's any ban for this year. Even if we don't announce any further exports, it's absolutely fine. In next season, I think the exports will definitely be lower, in the sense that last year they announced 6 million tons. Next year, it should be in the range of 3 to 4 million tons.
Okay. Amit, good morning. I have a couple of questions on the balance sheet front, which may concern investors. There's been a sudden spike up in your debt. You now have a net debt of 680 crores compared to cash of 100 crores that you had last year in December. What happened suddenly?
So, Sonia, this was expected. That is the guidance we've been giving to the markets as well. Because we have been doing our capex. Our total capex is around 3,500 crores. Of which we spent close to about 2,000 crores in FY23. So that kind of a debt level was expected.
Okay, so that was expected. Now, will you be taking up more debt for capex?
Yeah, so in FY24, there will be more debt because another 1,500 crores has to go. So they will be, but then, we as an organization are very disciplined in terms of our financials. So even at this kind of debt level, our debt to EBITDA is around 0.4, 0.45. And at the end of the debt raising cycle also, we should be in the range of around 1 to 1.5. So that's pretty comfortable debt to EBITDA.
So when you say that your core debt will go up further, what are you looking at? Currently you're at around 700 crores. Will you take it up to 1,000 crores as your capex proceeds? What is the, the target?
So it should, FY24 should end in the range of around 1,500 to 1,900 crores.
Oh, okay. 1,500 to 1,900 crores of debt by the end of FY24.
Net debt.
And you're net debt. Okay. And you're saying that this 3,500 crore capex that you announced, that's the upper limit, or will you be increasing your capex as well in FY24?
So as of now, this is what has been approved by the board. But given the strength in our balance sheet and our financial matrix, I do feel we have scope to do a little more.
All right. We'll leave it there. Then thank you very much for joining us, Amit, and it's a pleasure speaking with you here on CNBC-TV18. Good luck, as always. That's DCM Sriram. Lots of lines of businesses, some firing, some kind of not doing all that well.
Just want to make one mention. The stock is actually under a lot of pressure, perhaps because, the debt is going to go up significantly from 700 crores to 1,500 crores. And this at a time when there is weakness in the chemical business already. So pressure on the P&L, pressure on the balance sheet, perhaps something the street doesn't like.
And revenue growth of 10%, right? Yeah. I mean, in FY24 over FY23, so not exactly spectacular. 794, 795, stocks down about 3% right now. Just a quick glance on the market, which is still down about 60 points. We're at about 18,087 or so right now. Now, the next management we are speaking with on the back of earnings is KEI Industries. They reported an inline set of numbers in line with analyst expectations. EBITDA margins were maintained, profits went up, and they recorded a good growth in the cable and wire segment. Anil Gupta is Chairman and Managing Director at KEI Industries. He's joining us right now to take some questions. Mr. Gupta, good to have you with us here. Thank you very much for your time. Could you just start by telling us what was the volume growth in the cable and wire business? One. Second, if one looks at the entirety of the cable and wire business, the housing and winding wire segment reported a growth of just about 3% or so, just under 3%, and that's about a quarter of your overall revenues. What happened there? That's been the slower growth segment for you this time. Go on.
Good morning, Prashant. Yeah, we have achieved a highest ever sales in this financial year, around 20.7% up from last year, and volume growth has been in wire and cable business has been 23% over full year, and in the fourth quarter it is 13%. In terms of revenue, fourth quarter we have grown by 9%, but in terms of volume we have done increased sales by 13% in volumes, and overall 23% in wire and cable business over full year period. So far as wires is concerned, I think I don't have the actual data at the moment, but I don't think that we have grown by 3%. We have definitely grown by more than 20% in wires and winding wires.
No. I mean the housing and winding wire. That segment grew about 2.6% year on year. That specific segment, not the overall segment.
In our company?
Yes, sir.
No, I think there's some miscalculation in the data.
Okay.
We will provide you the data. It is more than definitely grown by more than 20%.
Okay, all right, Mr. Gupta, just to clear out a couple of numbers, the cables business, the growth is 8% in revenues, right?
Oh, no, 9% in fourth quarter. But
in fourth quarter?
Yeah.
The volume growth is?
13%.
13%.
13% for quarter 4 itself?
Yes.
So there was no price increase then? The entire growth is because of volumes in the fourth quarter?
Yeah, price increase was not there. In fact, the price was reduced because of the metal prices.
Got it. All right. So that clears out the way. We've got the volume number out there. Now you've guided that the housing wire business will grow, I think, by around 17 to around 18%, right? In FY24. Do you stick to that? And the housing and wire business in the past quarter was a little bit lower. Could you tell us why was that?
No, housing business and wire business, housing wire business has not grown, has grown by around 13 to 14%. I don't know from where you have got this lower number, and I'm still sticking to my point that we should grow by 16 to 17% in FY24 in overall wire and cable business.
Okay, so the overall wires and cables business, the growth that you're looking at in FY24 is about 16 to 17%, right?
Correct.
Okay. Mr. Gupta, hi, this is Sonia here. Just a couple of more questions. There is a greenfield expansion plan that you have of 800 crores. Can you tell us a little bit about that in terms of the timeline as well as what the revenue potential is post that?
Yeah, we are going to start this greenfield expansion construction by early June this year. And I think it will be around 18 months timeline when we expect to start the commercial production. The investment will be around 800 to 1,000 crore over a period of 3 years. And we expect a revenue of around 4,500 to 5,000 crore from this expansion. Apart from that, this year we are going to spend around 50 to 60 crore rupees in brownfield expansions in our existing factories, which are already underway.
All right. So this 4,000 to 5,000 crores of revenue potential post the expansion, when do you see it kick in? Is it fair to assume that part of it could kick in FY26? And I mean, what kind of a timeline are you looking at?
A little part of it can kick in FY25, but most will come in FY26.
All right, Mr. Gupta, you know, the extra high voltage cable, I think you were guiding that that is going to be growing at a faster clip. Could you tell us for FY24, what is the revenue potential, revenue target over there? And for FY23, how much did you achieve, EHV?
The EHV this year has been low. We achieved around 358 crore as compared to 500 crore previous year. But it was because of many of the projects what we are in hand. We had the order book of around 850 crore in this segment, but many of the projects could not be cleared because of the ROW issues and from the utility perspective. So the sales could not be achieved. But this year we expect it to achieve around 600 crore in this segment.
Oh, so that will be a big growth. You're guiding for a 60% growth on this sort of a base.
No, it is not 60%. Actually, from FY22 to 24, it will not be that.
Yes, on this low base, Mr. Gupta, we get that. In the previous year, you did 500 crores in EHV. The last year, you did it on 350 crores. And now you're saying things will normalize and you'll go back to around 600 crores. Are we getting that correct?
Correct.
Okay. Can you help us with some opportunities that you may be receiving as far as the railways is concerned? Because, you know, a lot of companies have come out. I mean, the ministry itself is giving out a lot of big orders in the space. Can you quantify for us what is your opportunity over the next couple of years?
We are doing a lot of business with metro rails and urban railway infrastructure projects. And in the railway itself, we are basically working on the electrical side of the cables, not on the signaling side. So we definitely there are substantial opportunities in the railways, but we are not in the turnkey segments in the railways and or not in the mainland railways business.
So this 16 to 17% growth that you spoke about in the wire and cables business in terms of FY24 volumes, have you factored in the business that you're getting from railways for electrical cables? Or do you think that, you know, once more of that business comes in, maybe you could do better than 16, 17%?
No, we have factored in all the factors and even including our capacity, available capacities, that how much we can do, and based on that only we have said that we should grow by 16 to 17% over FY24.
Right, Mr. Gupta, two questions. One is order book. What's the overall order backlog? What's the accretion to order backlog that you see? What you have visibility for into the next few quarters? And second, where do you see margins with all of the volatility in raw material prices in FY24, EBITDA margins?
We have an order book of around more than 3,500 crore at the moment, and we are having a good traction. Even in the April, the order booking was more than 600 or 650 crore rupees, and we are seeing a good order book coming from various segments like infrastructure, pipeline, industries, and housing sector also. Export has been a very good potential. This year we have grown in exports by around 18%, and next FY24 we expect to grow by more than 25 to 30% in exports. We have an order book of around 350 crore rupees in export at the moment, pending orders.
Okay, well, all the best. Yeah.
Sorry, Mr. Gupta, margins, could you leave us with a number? Would it be around the 10-10.5% level?
We achieved 10.69% EBITDA in this financial year, and we expect that it will be within this range or maximum up to 11%.
Okay, maximum up to 11%. All the best, Mr. Gupta. Thanks a lot for joining in. And congratulations once again. You've done a lot for shareholders, your stock that is. In the last 12 months, the stock is up about 55%. And the management is quite optimistic. So they say that they're looking at a 16-17% growth in their wires and cables business in FY24. And they've announced a big expansion plan as well that will start over the next 18 months. But moving on, the market is not bad actually. It's cutting its losses a tad bit. Back above 18,000 on the Nifty. The mid-caps are well in the green, so some dips are getting bought, not all of them. But let's see, the day is long. Let's move on. Market regulator SEBI's new advertisement code for investment advisors and research analysts has come into effect. Perhaps more beneficial for the sake of consumers. Yash Jain is standing by with all the details. Yash, over to you.
Well, market regulator SEBI has written to all investment advisors and research analysts on advertisement code. Now, advertisement code essentially draws out a broad framework in terms of what these research analysts and investment advisors can advertise and the way in which they can advertise their products and services. Importantly, in terms of what has to be done, all these research analysts and investment advisors will have to carry a list of disclosures which the market regulator SEBI has drawn out in every form of advertisement which they make across medium. So be it print, be it audio video, or be it social media, any kind of advertisement on the products and services of the community will have to carry this list of disclosures. Again here, what not to do will become more important than what has to be done. Here, market regulator SEBI has drawn out a list of things which will have to be prohibited from every kind of advertisement made by these research advisors and investment analysts. So these would include things like statements which are false, misleading, biased or deceptive and based on assumptions. Any misleading or deceptive testimonials will have to be avoided. Any promise or guarantee on assured risk-free returns will not be allowed as far as these advertisements are concerned. Also, extensive use of technical and legal terminology or complex language will have to be avoided. Apart from that, any statement which directly or indirectly discredits other advertisements or other intermediaries will have to be avoided by the community. Reference to past performance and use of superlative terms like best, number one, top advisor, research analyst will have to be excluded as far as the advertising material is concerned. Finally, any kind of advertisement by these research analysts and investment advisors cannot carry market regulator SEBI's logo, and a prior approval from SEBI recognized supervisory body will have to be taken on any kind of advertising material before they are released to the larger public.
Well, that's great for consumers, for investors, SEBI tightening ad rules, especially at a time where there are so many finfluencers, so to speak, coming out with investment advice and tips. So great thing for SEBI to come and do.
The only thing is that these rules are for SEBI-registered RIAs and investment advisors. This does not cover finfluencers. I mean, that category, which is that. I mean, SEBI, I think, is the SEBI chairperson also in the press conference recently said that that is a category which needs to be regulated. But these rules are for people who are already registered with SEBI. So actually, a lot of angst on social media, basically highlighting that while
people who
we are
need
being
to be regulated are finfluencers.
But yeah, there's a big.
But I don't think it's under SEBI's ambit anyway, right, to regulate finfluencers.
But I think something is coming. Yes, I mean, so the she was very clear. The SEBI chairperson very clear that we need to have some kind of regulation too, because it's exploding, right? So you need to have some common ground, some common rules to abide by for this to take shape.
Absolutely, and there's a lot of peddling of misinformation for commercial purposes, right? So I guess baby steps coming in. The first step is SEBI regulating a lot of the SEBI registered advisors. Well, let's do one thing. Let's take a quick break on that note. On the other side, Mitesh Thakkar will be joining in for some technical trades. Stay tuned.
Okay, welcome back. So the market's up, down about 60 points, 65 points. Market breadth, as I was pointing out earlier, is improved, and that happened within the first 15 minutes or so of trade. That 1:1 became not quite 2:1 yet, but there's a decent gap now between advances and declines. The railway story continues to chug along, and how? I mean, look at RVNL once again, 10% yesterday, another 10% today. Once again, volumes are just out of this world on RVNL. Every day, volumes have been super, super strong. So this is quite some story. From the end of March, RVNL is up 100% plus. I mean, I think just incredible moves in a month, little more than a month. Indigo still holds on to strong gains with a 6% pop. CET, which for the last 2 days was sulking after last Friday's big 9% move, is back again. CET is up 5%. I'm assuming that's the oil slump story playing out here. The oil refiners, standalone refiners and oil marketing companies are also higher. And then you've got something like Garden Reach Shipbuilders, which is up about 3.25%. So many new names into the mix, which were not there in the morning. Look at Sula, look at Aptus. Atul Auto was down 10%. It is seeing some recovery today with a 3% gain. So this is a market of stocks and so many moves to track. Mitesh is with us with quick thoughts on what he's making of the price action and any trades that he'd want you to take. He was saying in the morning, of course, that stay out, don't try and buy the dip right away. Mitesh, how's the view now?
Morning again, Prashant. I think on the index, the view remains the same. I think, we've had some kind of a dip and a mild recovery, but I think, broadly, it is a market which remains overbought on the hourly chart. So still slightly cautious. I think I would prefer to buy closer to about 18,017, 975 kind of a range. And on the stock side, though, I think, you were highlighting some of the stocks on the railway side, but the entire mid cap and the breadth of the market looks so positive that, you still would want to explore some longs over there. So Petronet is something which has come on my radar today. I think that's a stock which has made a fresh high. Recommend a buy here with a stop at 236 for targets of 252. And the other one which I like is Sun TV. That's after a long time come on the buying radar. That's a buy with a stop just below levels of 433 for targets of 450.
All right. Thanks a lot, Mitesh, for that. Well, let's do one thing. Let's also get a handle on what's happening in the world of commodities. Remember, the big headline is the overnight fall in crude. Crude was down 5%. But Manisha Gupta is here. Manisha, what's the one commodity you're looking at today?
I am keeping an eye on crude oil prices right now because there has been a considerable decline into this one and continues to even slide further as we speak right now. So 5% of a decline in the overnight market, and we are trading at a 5-week close for both the crude varieties there. And not just crude, if you look at heating oil, gasoline, natural gas prices, we've seen 4 to 5% of a decline come in for these as well. Natural gas prices actually are now trading quite low, and the heating oil is trading at a lowest since December 2021 right now. And for the crude oil prices, the prices did gain 1% for the month of April after 5 months of decline, and May has started on a very bearish note yet again. So further losses coming in on your screens there. Well, the sentiment has been quite weak in any case. We've seen weak economic data come in, and now with the US politicians discussing ways to avoid debt default also has dented the sentiment further, and the markets have gone in for some profit taking there. The US jobs opening fell for a third straight month for the month of March. And even as the OPEC and allies now will start cutting output starting from the month of May until December, the point being that one of the OPEC members, which is Iran, their crude output has surpassed 3 million barrels per day, and this is versus 2.1 million barrels in 2021. So we have seen constant increase in that. Not just here, if you look at the US crude production also has been on the higher side. Inventories barring US have been increasing as well, and that's weighing on. And the data, as I pointed out, manufacturing numbers, services data, factory activity from China and US have come in weaker than what the street was anticipating. And then expectation of further rate hike from US Fed and ECB in this week itself is constantly weighing onto the markets. I also want to put on screen on how volatile the crude oil prices have been in the last 1 year. So it was last year that we saw 14-year highs for the Brent prices at $140 per barrel. They're trading at 75 right now. The closing last year was at around 76. In the first quarter of this year, we've seen a 15-month lows in sense of crude oil prices at $70 a barrel. The 2023 range until now has been at 70 to 88. So we clearly are trading at the lower side of the range, with the markets anticipating that the floor is not yet created and you could be looking at further declines.
Okay, Manisha, thanks a lot for that. Well, the other stock that we're looking at, let's get back to tracking the stock markets now. Indigo is a stock that's up about 6%. Now, the question we're asking is, with Go First filing for bankruptcy, is the industry now heading towards a duopoly structure? And I'll tell you why. The insolvency of Go First will remove 9% of domestic supply in the aviation sector, and it can benefit Indigo in many ways. Higher market share, stronger yields in a capacity-constrained environment.